The catalyst is either the economy slowing down much more than what's priced in, or the Fed, now some combination of the two, or the Fed that's actually trying to lower rates to keep that soft landing alive. I mean, I think the big debate is what is neutral interest rate, real interest rate, R-star, what economists call R-star. The Fed thinks it's 50 basis points. There's some debate. President Kashkari suggested maybe it's a little higher, maybe it's 1%. And 10-year real rates, and I would look at the 10-year part of the curve. That most of us borrow, households, corporates borrow in that 5 to 10-year part of the curve. It's running close to 2%. So I would think as inflation comes down, the Fed gets more confidence, as Chair Powell said, that they can start to normalize, those real rates start to come down, and at least they can get to 1%, which is, I think, closer to neutral.
The gentleman from Yale, Ed Yardeni, suggests productivity started in 2005. Paul Sweeney pointed out to me there was a giant pause during COVID of our more productive, more efficient America. And then we've reinvigorated productivity here. Priya Misra, does a new American productivity that Michael Ferroli and Bruce Kasman see, does that change your call on interest rates?
So I think it would go back to what is real equilibrium interest rates. And I think the Fed's been in the 0 to 50 basis point range. If there is an increase in productivity, maybe that gets us closer to 1%. But here's the offset to productivity. There's a lot of talk about generative AI and technology and how that's improving productivity. It takes a while for that to get adopted within the business sector, within the labor market. It takes a while. So I would say it's not clear to us that we're there yet. Secondly, we've got demographics that go the other way. We have an aging population. And so I would say it's productivity and demographics and population growth that would imply, that would have implications for real neutral rate. And, at least the demographic side is going the other way. So maybe there's a move a little bit higher, and that's why I'm arguing could be as high as 1% real rate. But I struggle to see much higher than that, given how much time it takes and the fact that demographics are going the other way.
All right, Priya, we're going to have the question, I think, for the marketplace right now is what is the Fed going to do? Not so much what are they going to do, but when are they going to do it in terms of maybe pulling back on rates? And obviously the Fed was pretty consistent with their language that it's not going to be in March. Now there's some question in the marketplace. Will they cut in May or perhaps wait to June? What do you think they will do? What do you think that maybe they should do?
So I like that question because we have to constantly think about what they should do, which is driving the economic outlook and asset prices, and then what we think they will do. I think in terms of they want more confidence, which is why they took March off the table. I think they want to see at least 3-4 months of inflation. We have another inflation report this week, that inflation is continuing to come down, and not just the headline number, I think, or core. I think they want to see that the service side of the inflation picture is heading lower, because the goods side has done its bit. Goods inflation is in negative territory. Yep. We're in deflation. I think they want to see that service inflation continuing to come down. May or June, I think it's somewhere in that time frame that we think they'll cut. What they should be doing, I think they should be starting to normalize right here. I mean, the earlier conversation where we're talking about what is neutral, Fed funds is at 5.5. So, even if R star is higher and neutral rate is closer to 3%, we're really far from 3%. So I would have said start early, then you can go gradual, you can figure out where that neutral rate is. But realistically, March, May, June, what's a few months between friends? I think they're likely to start to cut rates sometime in the first half or early in the second half of this year.
Well, you're right. The goods inflation that's a thing of the past for most people. But boy, the services side. I mean, we have the consumer pretty strong here. The consumer has a job. The consumer's wages are going up. The consumer is spending. Maybe they're putting a little bit more on the credit card, but the consumer seems in pretty good stead right now. How do you see that?
So I think the economic data has been very strong. And, that explains why we've had this scenario of risk assets doing extremely well. The market's pricing in this soft landing. And I think rightly so for now. I'm a little more cautious because I think it's a fragile soft landing. It requires inflation to continue to decline. It requires the Fed to start to normalize policy for the soft landing to last. So I'm a little nervous further down for the consumer. But to your point on inflation, I think rent inflation or housing inflation is a big component of that service inflation. That is heading lower. I mean, we've seen new rents starting to not come down, but the rate of increase of new rents is absolutely slowing down. And so I think that housing inflation, the trend is clear, it's going to come down. To your point, the consumer is strong, but some of that is also, service inflation is not rising at the same rate. So I think what the Fed is likely to do is not wait for 2% on service inflation, but if the trend looks like it's heading closer to 2%, especially with goods in deflation, they can start to get that confidence